What's up, traders? For those that don't know me, I'm a top author on the TradingView platform. I'm a swing trader and I trade mainly Forex. Now in this episode, we will be speaking about a very important saying in the market. If most traders would learn to sit on their hands 50% of the time, they would make a lot more money. Now, if you know this saying, who is actually the author of this phrase, then comment below and let's see if you know it. If you don't, you will now understand why it is so important, because we will be making a live example in this analysis of when it is best to stay out of the market. And it's much more important than when you're supposed to be inside of the market and involved in it. Without further ado, let's get into it. So let's understand why this concept is so important by making a breakdown here on USD/JPY. So our usual multi-time frame analysis breakdown that, as you will see, will end up in being a situation in which you need to sit on your hands and react instead of predicting, because that is the most important thing in the market. And this will be a very important video because it will teach you an important lesson. Now, starting here from the monthly time frame, it's pretty clear that this trend line here, taken from this low here, touching as many candles as possible to get more confluence. As you can see, you just got a very major trend line here on the monthly time frame that the market is respecting in a very accurate way. Now, last month we had a break below of this trend line. As you can see, this red candle broke below the trend line, basically confirming that this is not a support anymore, but is actually resistance. So this trend line will act as strong resistance. And this is a very important thing to know, because if you basically know from the monthly time frame that you have a very strong level of resistance, you won't be looking to buy, because basically any buy order that you place goes against the technicals on the monthly time frame that, as you guys know, are very important. Now, here zooming in on a most recent price action, so basically looking at what happened inside of this area, you realize one thing immediately, that this is not only a very strong resistance area given by this trend line, but you also have a previous support turned resistance scenario. As you can see, this level here was acting as support, and now that is broken, is acting as resistance. So you have both the resistance of the trend line, plus you have a structural resistance. And if you look left, basically extending this box, you can clearly see that this was also a historical level of support. And since now it is broken to the downside, this is obviously acting as additional resistance to the price. So with all of this in mind, from the monthly time frame, we are expecting a push to the downside on this pair. Now, if we go on the weekly time frame, however, you have a completely different scenario. Why do I say this? Because on the weekly time frame, what you see is that if you look at the market from a structural point of view, you have left shoulder, head, and right shoulder. And also, if you look even closely enough, and you can basically be even more precise if you go on the line chart, you will realize that if you put a horizontal ray on this close here, which is the left shoulder, and I will explain this concept for you guys. If you put basically, if you go on a line chart, you're getting the closest in the market. So how the candles are basically closing. And this closes, so the bodies of the candles will act as very accurate areas of support and resistance. So if we go back to candles, as you can see, I put my horizontal ray exactly on the body of the candle, and as you can see, that acted as support. And that is exactly what you expect from the market. And these levels are actually extremely accurate. Now, with this in mind, what you're supposed to be doing here from the weekly time frame is look at the structure in the market. You know that you have a W formation, and as you guys know, after you have a W formation, you expect a push to the neckline. However, in this case, you got the push to the neckline, but obviously the market rejected this area because you knew that you had strong support around that area given by the trick of the line chart that I have just shown you, and that anyway, in a very simplistic way, is a head and shoulders. So this is a structural area given by the left shoulder. So with this in mind, on the weekly time frame, you're actually you actually have a bullish view in mind for the pair. So immediately you have a contradicting scenario on the monthly and weekly time frames, because as you guys just saw, on the monthly we are looking for shorts, but on the weekly we are in a bullish market. So by taking your Fibonacci from this low to the high, you also realize that the market rejected exactly the 382 Fibonacci of the impulse leg, because as you guys know, if the market creates an impulse in the market, let's draw it here. If the market creates an impulse in the market, if you want information on this retracement, you need to take your Fibonacci on the impulse, and that is exactly what we did. We took our Fibonacci on the impulse because we wanted informations on the retracement, and by informations I mean we wanted to know where are the strong levels of support of this impulse, basically on which the market will start the next push to the upside. And as you can see, the 382, since it was also lining up with this area of structure, obviously acted as support. So again, from the monthly we are extremely bearish, but from the weekly we have a bullish view in mind for the pair. Now let's drop on the daily time frame and see what kind of price action we're getting on the daily. Now here on the daily time frame we have again even more contradicting scenario, because on the daily time frame you clearly have a W formation, so you're expecting a red candle anytime. But that red candle will obviously, when it will happen, it will line up with this area of support, because as you can see, the market has found support here, the market has found resistance here, and when the market will go down here, it will find support. So again, you have another contradicting scenario, and this is one of those cases in which you will not be just entering a trade in any direction, because it is against all odds. You need to stack all the odds in your favor before entering the market, because in the end this is a game of reaction and not prediction, and most of all it's a game of probabilities. So you need to stack as many probabilities on your side as possible. So what is a good idea is to wait for further development. For example, if now what we will get is a strong push to the downside, breaking below this low here, then obviously you will be very much interested in this market. Why do I say this? Because if the market breaks below this low here, it basically confirmed that it has just created a lower low, so a low that is lower than this one here. And if the market creates a lower low, by definition of a downtrend, it has higher probabilities of creating also a lower high and continue with the trend to the downside. Because as you know, a trending market to the downside will create a series of lower lows and lower highs. If instead the market will from this area here start an impulsive phase to the upside and break above this high here, the market has created a higher high, and at that point on the retracement I will be very much interested in longs, because the market, as we know from the weekly time frame, is overall bullish. So from the monthly we are overall bearish, from the weekly we are overall bullish. What we need to see is the daily time frame aligning with either the monthly or the weekly, because at that point you have two confluences of two time frames. Now why are we not dropping on the 4-hour time frame? The very simple answer is this: when you're analyzing the market, the monthly, weekly and daily time frames are for basically determining the direction of the market. The 4-hour time frame is only for entry. This is a very important concept. The monthly, weekly and daily time frames are for direction. The 4-hour is just to perfect your entry, and that is also the reason for which here on TradingView you have them basically separated. These are the monthly, weekly and daily that are for direction, and these are the intraday time frames which are meant to take entries. Especially the 4-hour time frame is the most accurate. Now this was just to show you how you're supposed to understand when you don't have probabilities on your side in the market. This is a very important concept. Always be ready to stack as many odds in your favor as possible. You need to have at least two time frames that are lining up together before you can take this trade, and that is why we just said we need to see that the market has established either an uptrend or a downtrend on the daily time frames before we can take the trade. Now another thing I want to say is that if the market will break to the upside and create a higher high, obviously you will not be longing immediately, because that is never a smart thing. The market loves to make pullbacks. the market will always be ready to make a pullback, both if it is in a downtrend or if it is in an uptrend. At some point the market will pull back, and the reason for which you're supposed to wait for these pullbacks is because on these pullbacks you will be able at that point to drop on the 4 hours and take a much better entry with a much better risk to reward. You will be able to bank at least 1 to 3 for some nice risk to rewards if, when the market is here on the daily time frame, you will drop down on the 4 hour time frame and perfect your entry.
I hope you enjoyed the video. If you did, make sure you smash that like button and comment below. And also, if you want to learn our strategies, if you want to learn the way we trade, you can go and click on the link below on our website, www.transparentfxtrading.com, and you will be able to see what we offer in the mentorship program, which is everything that you need to know to understand how you're supposed to analyze the market. And also you will get the complete rules and explanations in our video sessions of how you're supposed to apply our 3 strategies. So the WM strategy, the ICI strategy, and the TL-TCL strategy. Looking forward to have you on board.